Hi there, I'm Mike Larson, Editor-in-Chief with MoneyShow, and I'm coming to you from the Investment Masters Symposium in Sarasota, Florida. I'm pleased to be joined by Ralph Acampora, hedge fund advisor for Hedge Friend, and Katie Stockton, founder and managing partner for Fairlead Strategies. Thank you so much for joining me.
Thank you, Mike.
Okay, so let's start with the big picture from a technical standpoint. I mean, that's obviously your specialty. What are you seeing in this market in terms of the best opportunities and sort of the outlook as we head into 2024?
Want to go?
Whoever wants to take it, go right ahead.
Of course, the best, right? What's the best of the best or the best of all? We don't play favorites, but we do find opportunities all the time. So that's the best thing about the market is that there's always something to do, right? Especially from a technical perspective, because really the world is our oyster. if you can be global macro in nature, there's always a trend to take advantage of. Unfortunately, we don't feel like we have convincingly that trend right now in U.S. equities. We are constructive, but there's some major resistance in play. So we're short-term bullish, but we're not yet long-term bullish. We're more neutral long-term in our thought process and positioning. But we feel that if we see this breakout, well, then we'll have a positive long-term technical catalyst. And then we think those best opportunities will be in the U.S. because the U.S. tends to be the source of outperformance long-term globally, on the equity side at least. And the other good thing is that we have an environment that has more optionality in terms of asset classes too. We have gold that just reached new all-time highs essentially, which is remarkable in this environment. We have treasuries completing what looks like an intermediate term basing phase at least. So I think there's a lot of opportunities out there, and that a diversified portfolio is better than concentrating.
Got it. Ralph, I know when we talked off camera earlier, you had mentioned that we had the great bottom in the stock market back in October 2022, and now here we are a little more than a year later. What's your take on where markets stand at this point?
Well, I'm glad you brought that up because that was October 13th when we had that huge decline and the Fed chairman was talking about 75 basis points and the market panicked. But by the end of the day, the Dow was up a little over 1,000 points in one day, up 8%. That to me was an engulfing pattern, the likes of which I haven't seen in ever. That was fabulous. So I've been long-term bullish. And of course, exactly what Katie's talking about. There are periods when, the bull market slows down, and we've had a lot of corrections on the way up. But the most recent big move up was coming out of the October low recently. And, technology stocks, fabulous. Yeah. But I agree, they're tired, I mean, that doesn't mean I'm negative on the market, but I need to see that money not leave the market, find another place to go to. And I love the quote, rotation is the lifeline of the bull market. And that's what I'm seeing. I mean, I'm seeing financials look good. I see REITs look pretty interesting. I'm starting to, I'm interested in airlines are starting to bottom, I think. And so I'm rotating.
Okay, all right. Katie, I thought you made a great point in your presentation earlier that it's, you're comparing charts to how the market looks versus how it feels. Can you talk about that concept a little bit more and what the lesson is you're seeing right now?
Of course, it's actually a point that I feel like unfortunately has been belabored this year about market breadth. The breadth has just been dismal at different times this year, especially during downdrafts. I mean, it was really the place to hide this year was the mega cap complex. Now, in order for the bull market cycle that's been in place to sustain itself, you need that rotation that Ralph cites there, and I think there's good potential for it. So the breadth is more sideways to lower, but the market's been higher, and that really is because of those mega caps and their huge footprint. And their valuations, I can't be the judge of that, but we know that there's still price momentum and relative performance there, so we still are bullish on the mega caps. But what we ideally will see is more participation from the likes of the financials and healthcare, especially because of their big footprints in the S&P 500. That will help confidence stay behind the market and continue to grow. To Ralph's point also on the opportunities more from a bottom-up perspective, these tech stocks, the high growth complex that has really just massive up moves over the past few weeks, those up moves, some of them are completing major 2-year basing phases. And that to me is something that really is a differentiating factor between this relief rally and past ones.
Can I ask her a question? What do you think of the breadth? Do you think it's bottoming or it's just too early? Because that would confirm, hopefully, my rotation.
Yeah, so
Yeah.
I would say it's neutral long
Neutral.
term. So
Yeah,
the range, unfortunately,
Yeah, I saw
can
your
kind of
chart
go either
earlier.
way. But
Yeah.
within the range, there's upside.
Yeah.
And I think that the breadth might, just like momentum begets momentum, perhaps
Yeah.
the breadth will beget more breadth.
So let's talk maybe a little bit about, put our teaching hats on, our methodology. What exactly is it that either of you are looking for to sort of confirm, okay, now there's enough of that breadth that I'm seeing. Now there's enough of this tentative rotation is turning into something more.
Just following up on what Katie just said about breadth, I agree. It isn't really coming on strong yet. So I'm not negative, but I would have to see that for me to be more encouraged that this market extends into next year. So hopefully you don't ask me about 2024 because I'm not too sure yet.
No, it's still early. It's still early. Well, one thing that you alluded to was what's going on in interest rates in the Treasury complex, and you had mentioned in your presentation it looks like we might, I don't remember exactly what your downside target was. It looks like, in your opinion, yields were rolling over. Can you talk briefly about that as well as what you're seeing in things like precious metals?
And this is important to contextualize the move in yields over different time frames because while I do think, not only think, that they have rolled over, they've lost intermediate term upside momentum, but they really haven't reversed their long-term course. And I don't expect them to. But I do expect more sideways to lower action from yields. And that probably is enough to help improve sentiment more broadly around equities. Because we've already seen that in a way. That a good sharp pullback has generated a very sharp relief rally in equities. So perhaps both of those trends kind of continue, but in more of a normalized fashion in terms of the slopes of their reaction. So we're looking for corrective action in yields for much of 2024 by the way things set up. That's based on some long-term counter-trend signals. But we would expect them to make a higher low within what we believe to now be a secular uptrend.
Anything you'd want to add in terms of the interest rate outlook that you're seeing?
Well, I like what she just said because if we do see what you're talking about, that would encourage me at least maybe the first half of 2024.
Mm-hmm.
Yeah.
That's where the signals project
Yeah.
out to. It's
Yeah.
about 9 months out as of last week.
Yeah.
Okay.
And I think, I don't know for sure, the first year of the election year is usually a pretty good year, I think.
so,
Yeah,
too.
I think so. So it might be bumpy
have
with
any
corrections.
say.
Yeah,
Got it.
I'm sure we'll have corrections and all, but I don't see anything huge on the downside. So selectivity is important.
I guess the last question I would ask, and this is probably for both of you, anything that you're really bullish on based on what you're seeing in the charts, and anything you'd really just sort of at this stage, knowing things can change, would kind of stay away from?
I like banks.
Thanks.
Oh yeah, I think especially the regional banks, which had been under a lot of pressure for a while, they look good to me. I have my eye on energy, although I can't pound the table just yet. Maybe it's a little bit outside of technical analysis. All of the stuff that's going on around the world. I mean, you could wake up tomorrow morning and they cut back an oil supply, and oh my God, you'd have a pop right away. But having said that, I don't see any major upside in oil, but I do see some support. So I'm willing to nibble there.
Anything, again, asset class, sector-wise, whatever looks really constructive right now versus the opposite?
Yeah, I would. It's nice to hear regional banks, by the way, because I feel like nobody talks about them, and we've just started talking about them too internally. But I think I'll go back to those basing phases because it's not something we often see. They tend to be long-term opportunities when they are resolved to the upside. And this is the high-growth complex, so primarily technology, but you're seeing them elsewhere. We just featured as one example from a bottom-up perspective, Domino's, the pizza operation, as a base breakout. But Snowflake and Spotify,
right.
These types of names are really set up in a way that I'm intrigued.
Yeah.
They're with high potential reward. Sometimes comes a lot of risk,
Yeah.
but I am encouraged by the setup.
Yeah, the restaurants. I even think some hotels, REITs.
Because
they
so
all,
many things had downtrended in 2022.
Oh yeah, they got crushed.
Sure.
So they're down. They buy low. If you have time.
But I feel like with hindsight, you can say, well, that was a nice opportunity.
Yeah, exactly.
Well, now I want to book a vacation. I'm hungry, and buy some stocks while I'm at it. So thank you so much. Appreciate your time, Katie and Ralph.
Cheers, Mike.
Thank you.